When a community in New Orleans gets the investment it needs, houses are built, jobs return, businesses grow, and an American city makes progress.
The Financial Sense Midweek Edition with J Puplava. Delving in depth with authors and experts into the key economic issues.
Well, with gold nearing 1900, you're hearing more and more talk almost on a daily basis from financial publications. Is gold in a bubble? Is gold in a bubble? Or is it merely an unrecognized bull market? Joining us on the program is Nick Barisheff. Nick heads up the BMG Group. Nick, let's talk about gold. Is it in a bubble?
Well, there's plenty of those kind of articles, so that's probably a good topic for us to talk about because there's so many of them that you lose count.
On the day you and I are speaking, gold got whacked pretty hard. We're back down closer to 1800, and the talking heads on the TV are just besides themselves with the fact that gold's down.
That's right.
So why don't we begin there?
I guess the issue is when you see the discussion on gold in a bubble, it's the same discussion by the same people that said it was in a bubble at 500, at 800, at 1,000, now at 1,800. So this being common rhetoric. Here in Toronto, there was a relatively well-known portfolio manager who, when gold was at about 300, said that his grandchildren would never see $500 gold. So there's a lot of people that have been wrong on this point over the years.
Nick, don't you think one of the reasons that they're wrong on this is, I mean, if you and I were looking at, I don't know, a consumer products company, an energy company, we could look at cash flows, we could look at production cost, we can estimate what profits, earnings are going to be. When it comes to the bullion itself, gold doesn't produce any dividends. It doesn't produce interest. And I think for a lot of guys in the financial industry, they simply don't know how to value it.
Well, that's exactly right. And the main problem with the understanding is that gold has been money for 3,000 years and still is today. So if you have gold ounces in a vault or $100 bills in a vault, they will also not produce dividends or interest, but they also don't have any counterparty risk. And it's just like money is not really an investment. It's just you're holding money. If you're holding money in a vault, if you want an investment, you take your money out of the vault and invest it in something that places your money at risk. You might not get all of it or none of it back. And in return, you can get dividends or interest. But if your money is sitting in a vault, all you can measure it is in terms of its depreciation, in terms of purchasing power, or its relative currency exchange rate. But that's a fundamental difference. There's a lot of discussion in the media about gold being an archaic relic and so on, and it's not money anymore, and so on and so forth. But that's not what the experts in the industry look at it at. It is traded on the currency desks of all the major banks and brokerage houses, not the commodity desks. So they understand it's money. It's held by central banks who are now increasing their holdings. And number three, 24 billion, a day is the turnover in London. So, and that's all due to its currency and monetary attributes. Once you understand that, then it becomes easier to understand that it's currencies that are being debased. And if anything, we're in a currency bubble rather than a gold bubble. And the amount that currencies can be debased is really astronomical. One of the better articles I've seen that your readers and listeners can go to is in Wikipedia. They've got a section on hyperinflation, and they go through about 37 recent examples of hyperinflations in different countries. And the kind of numbers you get are truly amazing. Like in Germany, gold went up to 100 trillion marks an ounce in 1923. The largest Hungarian note was something like 100 quintillion Pingos, and in Hungary, the inflation rate hit 41 quadrillion %. That's what a bubble is in currencies. And that's what I think we're headed to.
And I think another concept for people to, they have difficulty understanding, it's not the fact that gold is going up, it's the value of paper currency is depreciating.
That's right. That's the more accurate way to look at it. And if you take the major currencies, since about 2001, they're down between 80 and 85% in gold terms. And the latest action by Switzerland is another example where governments are intent on a race to the bottom. The Swiss franc was the strongest currency out there and some alternative to gold as a safe haven. But with a fell swoop, they've just changed that. They're going to buy all the junk paper that they can get their hands on.
And that brings me to a question, because in a world where people, let's say, don't want to put all their money in gold, we've had alternatives. In the 70s, we had hard currencies such as the Deutschmark, the Swiss franc. Today, we have four major currency blocks: the dollar, the euro, we have the Swiss franc, we have the Japanese yen. The Swiss have told us what they intend to do. They don't want their currency appreciating. The Japanese have told us likewise. The euro is in a mess, as is the United States. So it seems to me, Nick, that all roads are pointing to gold. I mean, what's left?
Well, that's exactly right, because in this current environment, gold is rising in all currencies, or currencies are all depreciating against gold. Up till now, the Swiss franc was the strongest and rose the least in gold terms, but now that's changed. So in terms of currencies, there is no longer any safe haven, and with the volatility and uncertainty in the markets, it's, in my view, getting time to just sit it out and wait for a direction to evolve. But while you're sitting it out, your gold is appreciating at a higher rate than any of the other alternative assets, and has been doing so for 10 years.
One of the, best cases against the gold is a bubble argument is all you would have to do is look at any large financial institution in the United States, be it a pension fund, be it a mutual fund, an insurance company, look at their portfolio and show me where gold, either in bullion form or gold stocks, represent a significant portion of their holdings. You can't find it.
From what I've read, the institutions apparently hold less than 1% in gold, and the same number applies to private individuals as a whole as well. So there's very little. You consider that the total above-ground bullion holdings are about $3 trillion in the world, and this is bullion, not all gold. And about half of it is held by central banks and, the other half privately. When you contrast that with financial assets, which doesn't include real estate, just paper financial assets, are about $200 trillion. So, we're not in a bubble when you've got $200 trillion in financial assets. If anything, we've got a bubble in financial assets rather than a bubble in gold.
When you look at what would happen to this market, and this is something that I often speculate on, and that is, as you just mentioned, institutions probably own less than 1%. We now have a situation where private investors own more gold than central banks do. And we also have a situation where central banks have gone from sellers of gold to buyers of gold. What happens, Nick, if gold represents or eventually becomes a 5% position in a portfolio? Where would that gold come from?
Well, there is no place for physical gold to come. The only adjusting factor is the price. And if you various studies in terms of comparing the price of, say, U.S. gold holdings to broad money supply and things like that, you get numbers like $10,000 an ounce. So that's where the adjustment would eventually come from, is to get into those kind of numbers. I think $10,000 an ounce is not unrealistic if the conditions that we're in currently, the level of monetary debasement and the bailouts and so on and so forth, to see $10,000 gold in 3 to 5 years out.
Obviously, pricing would become a rationing mechanism if demand rose substantially for an asset such as gold. Could you see a day that, let's say that, 2 years, 3 years from now, 5 years from now, John Q. Public wakes up and doesn't buy the fact that the core inflation rate is at 2%, or given the propensity of most central banks around the globe to be printing copious amounts of money, that the little guy starts looking for a haven, that you could get to the point where you would either have, number one, long delivery delays, as we have seen, like, for example, in 2008 or last year in certain silver products, there were delays as a result of production bottlenecks. But could you see that occurring more frequently?
Most definitely, and I think we could also see a major diversion between real physical bullion, paper proxies and derivatives of bullion. So we could see a big divergence there. When you get into a major hyperinflation, the thing is that people then are prepared to just buy anything at any price just to get rid of the paper. And that was clearly documented in a number of books in terms of German inflation. People are looking at, they don't care whether they're buying wheelbarrows or shovels or gold or anything else just to get rid of the currency.
So it would seem to me that you're getting to the point now, on the day you and I are speaking, gold got hit, we're closer to around, let's say, 1817 or 1820, that gold for most practical purposes becomes too expensive for the average individual. I mean, if you take a look at, let's say, 1820 gold, if you're looking at buying a gold eagle or a maple leaf, you're probably looking closer to $1,900 an ounce. Nick, not too many people can afford to pay $1,900 an ounce for a gold eagle.
That's where clearly the issue of silver comes in and fills in the gap. Even though we've had a dramatic price rise in silver, I think it's still undervalued, with respect to gold, because even though it rose in terms of highest percentage terms, I think it started from a lower position, that it was like artificially suppressed in a variety of ways. So it started from a lower position and rose higher than gold, but it still has got a long way to go.
Yeah, because the average guy can't afford to buy a gold eagle at $1,900 or even a platinum coin at much more than a lot higher price than that, but maybe $45 or $50. Some people may be able to afford amounts at that level.
That's right. Like they say that gold was the money of kings and silver was the money for common currency in all those years, just because of that price differential.
I always look at the large mutual fund holdings just out of curiosity to see if, the large players have really turned towards the gold market. I'm looking at, the portfolio of Fidelity Magellan, a very, very large fund. They have one mining company called Newcrest Mining, which is about maybe less than 2% of the portfolio. But as I go down their list of their largest holdings, that's just about it. I mean, you just don't see large holdings of Newmont, because I can remember, Nick, in 1999, if you were to look at a fund like Magellan or some of the large mutual funds in this country, I mean, it was not unusual to see 20, 30, 40% of a mutual fund invested in the technology sector.
Right, but now what we have is most portfolio managers, many investment advisors have been in the business for less than 20 years, so they're used to the last cycle, which has been in financial bull market and a gold bear market, and now that's changed. And when things changed, just psychologically, people do not adapt to the change. Like even if you look at equities, the equity bull market started in 1982. Most people didn't get in until after 1995. So it doesn't become apparently obvious, and it becomes the complacency, the normalcy bias, all these various psychological issues come in that prevent people from taking kind of an honest, open-minded reevaluation of the current conditions. They're stuck in a mindset and in a paradigm that they can't get out of.
Yeah, because anytime you talk to individuals about bull markets, they'll tell you that bull markets, and this comes from the technical side, have 5 waves to them, 3 up waves and 2 corrective phases. Mm-hmm. And in the first wave of a bull market, it's the smart money. It's the people that get in. I guess it would have been the people that were buying gold back in the year 2000, 2001. Then you get a corrective phase. We certainly saw that in 2008. And then you begun the second wave of the bull market where you begin to get more institutional acceptance.